Neel Gopalakrishnan, Director Corporate Ratings at S&P Global Ratings, is joining us now. They've conducted a very deep research and are discussing the outcome of that. Neel, thank you so much for joining us. We believe you've done a very broad-based research and a report that 91% of Indian companies actually have very decent liquidity position right now, especially at a time when liquidity is an issue globally. How does stack up versus historic averages? What does it reflect also?
That's a good question. And when we say 91% of a rated portfolio has sound liquidity, what we mean is that 91% of companies have either an adequate or strong liquidity position under our criteria. And just for the benefit of audience, to explain what these terms mean, the way we measure liquidity is the sources of funds of the company to the projected uses of funds over the next 12 months or 24 months in the case of investment grade rated companies. And if this ratio is above 1.2, we consider it to be adequate. And if the ratio is significantly less than 1, we consider it to be weak. So what we are saying is that 91% have a ratio above 1.2, which is quite comfortable. And liquidity is an important supporting factor of the strong credit quality of our rated portfolio today. Because if you look at previous incidents of credit stress, this arises more from companies being in a position where they find it difficult to access liquidity. And today's environment is quite the opposite, where especially onshore, liquidity is abundant, and companies have been able to tap into that liquidity to refinance their upcoming obligations. That's a key reason why we have seen lower credit stress in India compared to some other emerging markets, notably China in the last, say, 12 to 18 months, or even Indonesia.
Neel, your report also suggests that net debt to EBITDA of corporate India is actually decelerating and may actually fall further. How much of that is actually EBITDA going higher or debt actually falling from here on, debt levels?
You make an interesting point here. And there's actually a difference across sectors on why leverage is falling. So if you look at corporates, including the capital intensive utilities and infrastructure companies, what we note is that absolute debt is falling. So if you look at aggregate debt of our rated portfolio as of fiscal 2020 to now, absolute debt levels have fallen. And this is not just a few companies, it's again quite broad-based. And I think here the driver for reduced debt is more capital discipline from companies. Many companies have publicly stated that they want to reduce debt substantially, and that's what is driving this. Whereas if you look at utilities and infrastructure companies, aggregate debt is increasing because of the capex. But there, what's happening is earnings are increasing as and when these capacities get commissioned. And because of the higher earnings, your leverage is falling, leverage measured by debt to EBITDA. Now, consolidated, if you look at both corporates and infrastructure companies, by our estimates, between 2020 and 2024, we estimate EBITDA of companies on average to be about 50% higher, but the aggregate debt is expected to be largely unchanged, which is a good reflection of how credit quality has strengthened during this period.
All right. So let's talk about, if the borrowing is happening at relatively lower rates than earlier, what would an increase in rates be? Will that cause a problem going forward?
Again, this is something that will affect companies differently depending on where they are based on the placed on the credit curve. What we notice is some of the higher rated credits, especially the investment grade rated companies, they're able to fund their capex significantly out of free cash flow. So they're not very dependent on external funding as such. So they will be insulated to the cost of funding. Whereas companies lower down the credit curve, which borrow to fund their capex, are exposed to this interest rate hike. But as you rightly pointed out, onshore funding costs have not increased as much as offshore. And globally, we talk about funding costs as having gone up. But onshore, we observe the companies are able to fund at almost similar rates as they used to a couple of years back. And this is a function of a couple of things. One, policy rates in comparison to developed markets have not gone up as much. And credit spreads, which have widened significantly globally, are at almost the same levels as a couple of years back. So I think Indian companies currently enjoy significant funding advantage onshore versus offshore, which also explains why we haven't seen many offshore bond issuances this year.
All right, Neel, thanks very much for joining us with those insights.